And when you see what just happened in Washington, you realize why this moment matters more than most people think. The so-called Crypto Clarity Bill just went through markup, and buried inside it is a move that could quietly reshape who really benefits from crypto in the years ahead. At first glance, the market panicked. Odds of passage dropped sharply, then rebounded just as fast once lawmakers confirmed the vote would still happen. But while traders were watching percentages, something far more important was happening beneath the surface, because this bill doesn't just bring clarity, it redraws power, and right now, the banks are positioned to win. Here's the core issue. Under the latest draft language, passive yield on stablecoins is effectively banned. That means if you simply hold stablecoins and earn yield, the way millions of people do today, that income stream could disappear overnight, not because it's unsafe, not because it failed, but because it competes with banks. If you're passive, yield is gone. If you're active, meaning you take risk, trade, structure products, or operate inside approved frameworks, that's different. And guess who is best positioned to do that? Banks. This is why many in the crypto community see this as a retreat, not progress. After months of negotiations, one of the biggest value propositions for everyday users is suddenly on the chopping block. Supporters of the bill argue that killing it over yield would preserve the status quo, and that would be worse. But critics see something else happening. They see an issue that was already settled being reopened. They see banks getting a second bite at the apple. They see economic benefits being redirected away from users and back into legacy institutions. And that raises a fundamental question. Should crypto give up one of its defining features just to get a bill passed? Supporters say compromise is necessary. They argue concessions bring bipartisan support and more changes will happen later, but others are drawing a line. Because once yield is gone, it doesn't quietly come back. This isn't just clarity, it's control. And the timing couldn't be more telling. At the same time, lawmakers debate consumer protection. We're watching politicians flirt with token launches, meme-style experiments, and speculative narratives that collapse in minutes, wiping out retail while insiders walk away untouched. That contradiction is impossible to ignore. On one hand, Congress claims it needs to protect users. On the other, the system still allows concentration, insider advantage, and asymmetric outcomes. That's why some in the crypto legal community are pushing back hard. Their argument is simple. Sharing economic benefits with network participants is the foundation of crypto. And it is not the role of lawmakers to decide winners and losers. If crypto becomes just another gated financial product, then something fundamental has been lost. Now there is growing pressure to delay the bill. Some call for more hearings, more scrutiny, more time to understand what this actually does. Others want it rushed through before opposition solidifies. And here's the warning. When laws are rushed, mistakes last decades. Financial regulation isn't something you fix later. Once it's locked in, entire generations live with the consequences. This is why the yield issue matters so much. Because while crypto is being asked to compromise, banks are having one of the best runs in decades. Bank stocks are up, earnings are strong, regulatory pressure is easing, consolidation is accelerating, and despite political noise, Wall Street is betting that very little will actually change. That should concern you. When the legacy system is comfortable, it rarely reforms itself in ways that empower newcomers. The updated text goes further than many expected. Passive stablecoin yield is banned not just for issuers but across service providers. Rewards for simply holding are out. Activity-based rewards tied to payments and certain transactions may remain within approved frameworks. Bank lobbying intensified to close perceived loopholes and press stablecoin programs closer to the traditional banking perimeter. Major industry players have warned they may rethink support if the language shifts from disclosure toward outright restrictions, with billions in annual incentives at stake. Proposals floated include limiting rewards or forcing issuers into bank charter regimes, effectively migrating crypto yield into legacy structures. The industry frames this as bigger than profits. If dollar-based stablecoins are weakened, foreign digital currencies gain ground just as on-chain settlement scales globally. Stablecoins exploded where trust is low and inflation is high because access matters. Cutting yield reduces utility and slows adoption. This isn't about chasing hype, it's about designing a system that shares benefits with the people who power it, the users. And that's the choice in front of us: protect users or protect incumbents. This bill is not entirely negative. There are provisions that could reshape the market in powerful ways. Certain digital assets would be classified as commodities quickly, opening doors to institutional participation, exchange-traded products, and capital migration from traditional finance. Self-custody is explicitly protected. No federal agency could prohibit you from holding your own digital assets in a self-hosted wallet. That matters. A lot. It means crypto's core principle, ownership, survives this phase. And once clarity exists, decentralized finance doesn't slow down. It accelerates. New on-ramps, new off-ramps, tokenized stocks, real-world assets moving on-chain. Clarity attracts capital, talent, and products that were sidelined by uncertainty. Infrastructure scales. Liquidity deepens, markets mature. Ironically, this could become a Trojan horse. Short-term concessions may give banks comfort, but long-term clarity could unlock systems they cannot control. Because crypto isn't just about yield, it's about access. Retail investors defend it fiercely because it gave them something no system ever did before: direct participation. That's why stablecoins exploded in places with unstable governments. That's why tokenization matters globally. This technology doesn't stop at borders. Policymakers still struggle to grasp this is no longer a niche industry. It's a generational shift. Whether this bill passes cleanly, badly, or not at all, the direction is set. The real question is whether lawmakers protect users or protect incumbents. If you care about this issue, make your voice heard. Tell your representatives one simple thing. Protect my yield. Protect my custody. Protect my access. Because once those are gone, they don't come back quietly. Here's what to watch next. Final language on yield restrictions, definitions that trigger commodity treatment, and the precise protections for self-custody. For users, know the difference between passive and activity-based rewards. Review where your yield comes from and what happens if it's switched off. Transparency is key. Fees, liquidity incentives, and risk. If yield requires active participation, understand the terms. Separate counterparty risk from smart contract risk. Voluntary activity-based rewards are not the same as guaranteed interest. If yield disappears, utility still remains. Fast settlement, low fees, and global access. Remittances and payments don't vanish. Merchants can still accept digital dollars. Activity, rewards, may offset some lost income while rules evolve. Consider diversification. Keep emergency funds off risk. Use self-custody where appropriate, and stay nimble as policy finalizes. Education is your edge. Understand how charters, disclosures, and platforms differ, because labels change, but incentives don't. Zoom out. We may be trading one friction, uncertainty, for another, constraints, but clarity also seeds growth. Banks may win the first round on yield, yet the architecture of open networks keeps compounding. Access, not just yield, is the revolution. Self-custody plus clear rules equals new rails that anyone can build on. And once millions have access, the center of gravity shifts from institutions to participants, slowly, then suddenly. If this breakdown helped, make your voice count and keep this conversation visible. Hit like and subscribe to the channel. Express Econ Geo Finance Insights. Drop a comment below. Banks are winning. Do you agree? Should crypto hold the line on yield or take the deal? Protect my yield. Protect my custody. Protect my access. This is Express Econ Geo Finance Insights, and this story is far from over. Stay informed, stay sovereign. I'll see you in the next one. Thanks for watching.